Okay, in the previous lessons, we discussed what happens when you purchase at the same time a call and a put on the same underlying with the same maturity and same strike price, and this leads to a strategy called long straddle, or when you purchase a call and a put with different strike prices, same expiration date, same underlying, and that leads to a long strangle, which is similar to this one, but it has a maximum potential loss, not in one single point, but in a region between the two strike prices of the two options. And as we have seen so far in multiple situations, the doubt could be, is it better to be a buyer in situations like this, or is it better to be a short seller? Because, okay, one point could be, I expect a strong movement in the price of the underlying, but I cannot foretell the direction. So why not being able to take advantage of a strong movement in the price, no matter the direction? And this is what makes reasonable the idea of creating a long straddle or a long strangle. But the problem is, what are the odds in favor? Because, okay, if the movement in the price is really significant, the profit can be very high, okay, but the question is, how many times does it happen in the real world? Because, you know, one thing is the model, one thing is the real world. So now we have to add another ingredient into the recipe, into the trading recipe, and it's the probability, the matter of the probability. So let's focus on a specific case. Later on, I will show you some distributions of returns of some stock indexes and also some stocks, including Apple, Microsoft, and McDonald's. So let's focus on a real case on one of these stocks. Let's take Apple, just to say. Apple closed for $270 and something on last Friday, December the 6th. So for now the market is closed, but here we have the prices marked on the closing of last Friday, and these are prices we can use in order to do some examples. So let's take the call and the put at the money, 270, and assume we want to purchase both of them, assuming that within today and January the 17th, the price of the stock could move significantly far from the current value, okay? So we could take the mean price, but for the sake of the example and in order to use prices that you would have for sure in case you did this trade really, you would get. So let's hit the ask prices. So 705 for the put, 825 for the call. Let's look what it means. In the option tool, create new strategy, stocks USA, call, long, strike 270. I cannot remember the price anymore. It's 825. Let's buy one. Add another instrument. Let's add the put. It was 705. 7.05. Close the strategy. And here we go. Okay, this is the strike price, 270. The break-even points are, let's look for them, more or less 254.5 on the downside and more or less 285.5 to the upside. And indeed, we have total premium paid $15.30, so the break-even points are 270 minus 15.30 and 2070 plus 15.30. So this is the payoff, and you can see that just to say, if the price goes to 320, you will have a profit more or less equal to $3,500. in front of a maximum potential risk of 1,530. Okay, so now let's do some calculations. From $270, an interval of $15 per side, it's equal to, let's do it here, 15.30 on 270, let's do it in percentage. It's a 5.67% on both sides. So the losing range is about 11.34%. Okay, we have a 5.67% in both directions just to reach a parity. And then only if the price goes over plus 5.67% or below a minus 5.67% in respect with the current price, we finally get into the profitable area. But now, once again, the question is, are odds in my favor, yes or no? Because this is the question. Let's look back just for a second to this slide in the presentation. Do you remember we overlaid the normal distributions on the price chart? And we said, if we could say that the distribution model of the returns is normal, then given the average, which usually is very close to zero, meaning that the expected return today to tomorrow, today to 2 days, today to 3 days, 5 days, 10 days, 20 days, is more or less to be at the same point at the end of the period. This means that the expected return is zero, the highest probability value is zero, no return over any time period. More or less, of course, later on we will see that the average is not exactly zero, but it's quite close to that. So, assuming that the distribution of returns is normal with the average in zero and the standard deviation equal to the historical volatility of that asset, then we could predict with a specific probability the price interval over some period of time in the future. And that is what we're going to inspect in this lesson. We are going to see whether this model really applies to the real markets or not. So let's take this spreadsheet. There's another macro in it. The idea is to automatically create the chart of the returns over some time period and compare what the stock or the index or whatever we are analyzing should behave according to the model and how it really behaves according to its history. Okay, so this is what we're going to do. Okay, so let's start exactly from Apple. Here we have all the closing prices over the last 21 years, more or less, from December the 31st, 1997 up to December the 4th, 2019. So it's a lot of data. It's 5,500 and something closing prices, and this is what we're going to do. We are copying and pasting these data into this table. Then we were looking at a trade given 39 days maturity. So the question is, what are the odds in 39 days to stay within a specific price region or getting without of it and getting out of it? So let's do an analysis. Over 39 days, I have to manually change the time period. 39. What we're going to do is to, of course this is in Italian, but never mind. What we're going to do is to group in classes the returns, the 39 days returns over the last 21 years, more or less. And later on I will explain why we're grouping them in classes. The classes will be 0.50% with each. Let's do this. Okay, let's just wait a few seconds. What we will get is the chart of the returns and a synthetic table that shows the comparison, here we go, between the model and real time. Let's start from the chart. This is the chart of the returns in every 39 days over the last 21 years, more or less. What comes out of the model, it seems more or less equal to the normal, okay? It's not exactly a bell, it has some particular characteristics. For instance, the maximum frequency is not set in the middle of the distribution, but in this case it's a bit into the positive half of the distribution. The distribution is not constant in its behavior, because according to the model, every event getting close to the mean should have a probability a little higher than the previous one, and getting over the mean, any subsequent event should have a probability a little lower than the previous one. This doesn't happen in the real world. You see, this is higher than this, and this one, just to say, is lower than that, and here this is higher. No, this is lower than this, that should be lower. So there are some anomalies, and one of the most significant anomalies that make the model makes the model absolutely ineffective in respect with the real world is the tails, because according to the model, according to the normal distribution, the tails should go down to zero very quickly. Here, these events should not happen according to the model, and yet they happen, and they happen with frequencies significantly different from zero, meaning that the tails are much higher than what the model would suggest. But let's look at some numbers. Here you can see the mean is absolutely not zero. We would have expected a mean not significantly different from zero. In this case, we have a 5.78%. Why is that? This happens because in the stock market there has been a positive bias over the last 20 years, especially for some stocks, and Apple is one of those. And this leads to a mean in the returns which is absolutely not zero. What we can expect, as it happens for the definition of probability, is that the mean would be very close to zero over a very long data series, a very long number of observations, maybe in a million returns data series. Then the mean would be something very close to zero. In this situation, over the last 20 years, I repeat, there has been a very positive bias in the price trends, so the average is absolutely not zero. It's very far from that. The standard deviation is 16.71%. So, according to the model, in a price interval, in a return interval between mean minus one standard deviation, and this makes minus 11%, more or less, and mean plus one standard deviation, and this leads to plus 22.5%, there should be a 68.3% of returns. What happens in the real world is that in front of 3,741 theoretical observations between this interval of returns, in the real world we have 75%, not 68%, and 4,143 out of 3,700 and something expected. So, as you can tell from this data, the real distribution of returns is much more concentrated on the mean than what the model would suggest. Let me repeat this because this is very important. What you could expect, according to the model, the normal model, is that between the mean plus and minus one standard deviation, leading, just to say, from this to this value, more or less, here we should have a 68.3% of observation, according to the model. According to the real world, the real distribution of returns of this stock, Apple, what happens is that in this interval, the same that the model would say you will have 68.3% of observations in between, In the real world, I repeat, we not have 68.3%, we have 75.63%, meaning that the real world is much more concentrated on the mean, it's much closer to, in respect to the mean, than what the model would suggest. What does this mean? This means that if you purchase calls and puts at the same time, expecting that the price will move significantly far from the mean, you will be wrong 75% of the time. Okay, so 3 times out of 4, you will be wrong. And this is the answer to the question, are probabilities on the side of the purchaser of a straddle or a strangle, or are the odds against him? And here we have the answer. Odds are against option buyers. And this is the statistical premise to the convenience of being short sellers of options and not buyers of options. Did we took by chance a specific case? Maybe on any other asset it doesn't happen the same way? Let's check it, because once again this is a very important matter. So let's look at Microsoft, just to say. Let's erase the previous work. Another thing, let me change the time frame of the analysis. Let's keep the analysis on the stock Apple, and let's just change the time window. Let's take 5 days, just to say 5. Okay, let's do this again. And here we go. Here the chart of the 5 days returns. Once again, you see similar distribution, similar to the normal, but it's absolutely not a bell. What usually happens is that the bell is something like this. So as you can see, in the central part of the distribution, lots of these columns get out of the theoretical model. The theoretical model would stop around here to the top, to the central part of the distribution, where the highest values of probabilities are expected to be, and the real distribution gets out most of the times from the theoretical model. Let's look at the numbers, the synthetical numbers. The average is 0.73, the standard deviation is 582, so between -5 and +650, we should have 3,765 5 days returns. In the real world, we have 76% of them, 4,200 more or less. So once again, the real historical distribution is much closer to the mean than what the model suggests, much more concentrated on the mean. And once again, if you purchase a call and a put at the same time, assuming that the price could get out of the losing range, you will be wrong 75% of the time, 3 times out of 4. What if we change the time frame to, let's say, 2 days, just 2 days? Look at that, 68% of probability to be between -343 plus 4.02 according to the normal model, 78% in the real world. Here, if you purchase a call and a put on a 2 days basis, assuming that the price will get out of the losing range, you will be wrong 78% of the time. Okay, this applies to the stock Apple. What about the stock Microsoft? Let's change the subject of the analysis. Let's erase the previous work. Let's take Microsoft, copy and paste, and here we go. There, if you buy a put and a call, you will be wrong 79% of the time. What happens with McDonald's? Here we go. And once again, 77% of the time, almost 78% of the time, you will be wrong if you expect a strong movement to the upside or on the downside. This applies to stocks. What happens with the currency? Just to say, Euro FX, Euro versus US dollars. Here, 73% of the time, not as much as it happened with the stocks, but yet, even in this case, even in the case of a currency exchange rate, you will be wrong most of the time, 73% of the time, assuming that the price will move significantly within a 2 days range. What happens with stock indexes? S&P 500. Let's check it. Here we go, 77% of the time you will be wrong. The average is very close to zero, 0.06%, and still there is a positive bias, not very significant, but still positive. Standard deviation over a 2 days horizon, 1.62%, so between minus 157 and plus 1.68, mean minus 1 standard deviation, mean plus 1 standard deviation, you would expect 68% of the observations, 3,759 returns. In the real world, you have 4,250 and 77% of the time, not 68%. What happens with the German DAX? The German DAX has a very positive bias due to the fact that it includes dividends. It's a total return stock index. So what can we expect is a positive bias in terms of the mean. Let's see what happens. Here we go, 0.06% the mean, 2.08% the standard deviation, the historical volatility. So between -2 and +2, we have 68.3% of the observations, 3,800, but in the reality we have 76% of the observations, 4,245. What happens with the Italian stock index, the FTSE MIB? I forgot to show you why we have to group in classes the returns. I will do it right away after the results of this analysis. And here we go, 0.02%. The mean is much closer to zero than it happens with any other stock index. The standard deviation 2.13%. The expected number of observations between -2 and +2 and something is 3,800. Real world 4,200. 76% of the times you're wrong if you purchase a put and a call at the same time, expecting that the price will move out of the losing range. Why do we have to group in classes data? Here we can see how the macro works. It calculates the return over the time period of the analysis, and then it groups in classes according to what is specified in the code. Why is that? Because if we put on a chart all these 2 days returns, what we would have would be something like this here. And this tells us nothing, because how do you read this? The only way to make this readable is to group returns in classes, so to be able to reach a chart like this that clearly states that the behavior of an asset is similar to the normal, but with some specific differences and blah, 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 okay? According to the model, we should also have very low probabilities, very close to zero, to observe significantly far from the mean events significantly far from the mean. What the real world shows us is that the probabilities are low, but absolutely not going down to zero very quickly. Indeed, sometimes we have some events that out of the blue show probabilities much higher than what the model would tell. And this is a warning because, okay, most of the time probabilities are in favor of the short seller of options, but the short seller of options has to be prepared to the chances to face a tail event much higher than what the model would suggest. So this is all a warning. Let me repeat it, because you have to be very careful in short selling options because odds are in your favor most of the time, but when they're not, things can be very, very unfavorable. So you have to know how to manage those situations if and when they show out. Let me show you that with the chart. Let's take an example of a strategy on, let's keep Apple. What if we take a very short maturity? I don't know, let's take just a few days, December the 13th, this Friday, so it's 5 working days. On the at the money strike, we have 3. No, here we have to look at the bids because we are selling 289 for the call, 230 for the put. Let's try and see what happens. We short sell the put short 2,270 for 230 per share, and we short sell the call, same strike, for 289. What happens? Here we go. This is the payoff. As you can see, we have a profitable range between strike plus and minus the total premium collected, so more or less between 265 and 275, so $10 range. We have a $10 range, profitable range. The maximum potential profit is $519 due to a total 5.19 premium collected from the short selling of both the call and the put. And then what happens if we get down to, I don't know, $235? If we go down to $235, then the loss would be $2,981. So once again, chances, odds, probabilities are in favor of short sellers, but you have to know how to manage the risk of tail events. How can we manage them? Let me introduce what you will see in the next lesson. You can add long options on both sides or on one side, and you can do it symmetrically or asymmetrically, and this will lead to different strategies, to iron condors, to iron butterflies, to asymmetrical condors. You can call them broken wing condors or asymmetrical butterflies, broken wing butterflies, and other variants that you could experiment, changing the distances between the purchasings and the short sellings, and assuming, for instance, 5 strike price distance for the long call and a -10 and a 10 strike distance for the long put, or vice versa. You can try an infinite number of possible combinations. So for now, that's all. Thank you for your attention. Don't miss the next lesson about iron condors and iron butterflies.